Welcome, everyone, to the Planet MicroCap Showcase Toronto in partnership with MicroCapClub. I'm your host, Robert Kraft, and I'm very excited to host this virtual keynote for you all here today. By way of introduction, over the last 30 years as a corporate and securities attorney, Lynne Bolduc has structured and implemented billions of dollars worth of business and financing transactions and has successfully represented clients in closing complex transactions across multiple industries. Lynne specializes in crafting creative financing solutions for companies wanting to raise money, go public, sell, or acquire other companies. Lynne's achievements include landmark security transactions, expert witness services in cases with high-profile public figures, and impactful speaking engagements, advocacy, and publications reflecting her unwavering dedication to her profession. Her numerous awards include being recognized as a Southern California Rising Star Attorney by Los Angeles Magazine and Southern California Super Lawyers 3 years in a row, and being named an Orange County Visionary by the Los Angeles Times. So with that, I'd like to introduce Lynne Bolduc. Lynne.
Thank you, Bobby. I'm so glad to be here.
So Lynne, thank you again for doing this keynote with us here today. I know that you have prepared a nice presentation. So do you want to pull it up and we'll go from there?
Sure. Yep. Before I do my presentation, I just wanted to share with the audience a recent deal that I did that I'm pretty proud of. Recently, we took Bitmine Immersion Technologies, Inc. public on the New York Stock Exchange. Bitmine is a crypto treasury company. Bitmine raised $21 million in this IPO. Interestingly, this was the first crypto IPO filed under the new presidential administration. After the IPO, we represented Bitmine in a PIPE offering that raised $253 million. A PIPE is a private investment into public equity. The PIPE offering set precedent by being what we believe to be the first funding of an offering with cryptocurrency instead of cash approved by the New York Stock Exchange. Together with the IPO, the company raised $274 million in about 30 days. The company is now conducting an at-the-market offering of up to $10 billion. Now, I thought that I would share how to raise money in the US with this audience because I thought that would be of value. So let's begin. Let's start with the types of offerings. There's really only two types of offerings: a private offering, also known as a private placement, and a public offering. Private offering is not registered with the Securities and Exchange Commission, the SEC. It's exempt from registration. A public offering is registered with the SEC. It results in the company becoming a public company, generally with stock that is trading on an over-the-counter market or a stock exchange. I'm going to start my discussion with the types of private offerings available. And there's two things to keep in mind as we work through the options available. The choice of a private offering generally depends on whether the company needs to advertise in order to raise money and investor suitability. Now, advertising is the traditional advertising, such as in industry publications, radio, television, internet, social media. But that concept also includes general solicitation. That means the company can contact people with whom they do not yet have a pre-existing substantive relationship. Now, investor suitability generally comes down to, is the individual an accredited investor or a non-accredited investor? An accredited investor is an individual who has $1 million net worth, not including their primary residence, or $200,000 in annual income over the last 2 years, with the reasonable expectation of the same in the current year, individually, or $300,000 annually over those same time periods in conjunction with their spouse. Now, most companies start raising money in what's called a friends and family private placement. This is under Rule 504 of the Securities Act of 1933. And what's significant about this offering is no advertising is allowed. So a company can raise up to $10 million every year from an unlimited number of accredited and non-accredited investors. That's a significant benefit to the offering. A company can raise money from non-accredited investors. There's no specific requirements for disclosure other than you must disclose all material information about the company in the offering. This usually takes the form of a formal disclosure document, such as a private placement memorandum, but could also take the form of a business plan, an executive summary, a presentation on a PowerPoint. You should include the risks of investing in your company in the offering as well, though. Now, a significant detriment to the offering is no advertising, no general solicitation. The officers and directors of the company may only contact people they already know, i.e., their friends, family, business colleagues, etc. They cannot get referred to investors because they didn't know them already. So, this offering, it's a good place to start because you can raise some money to get a start in your business to move forward, but it's not very widespread. So people don't generally raise a lot of money using this exemption. The last issue I want to discuss with this exemption is that in the US, we have 51 sets of laws we have to comply with. One is federal, and then 50 states. Now, not all states recognize this offering exemption. So a company has to determine that there's another available exemption in the state of residence of a potential investor before they can take their money. This is a significant detriment because not all states recognize this offering. For example, New York. You can't sell securities using this exemption to residents of the state of New York. Therefore, this is very limited. Now, after raising some startup capital, companies generally go on to raise more money privately. And to do that, they generally rely on Rule 506. And they have two different allowances under Rule 506B and C. Now, 506B is very commonly used. It does not allow advertising, but you can raise an unlimited amount of money from an unlimited number of accredited and up to 35 non-accredited investors. A disclosure document is required, and if you're going to use the 35 non-accredited investors, that disclosure document has to follow specific guidelines. There's specific requirements for what needs to be in there. You don't have to take advantage of the non-accredited investors. We often recommend that if you can only raise money from accredited investors, that you do that. Non-accredited investors might have the need for their money back. You don't have the money because you spent it on the uses that you said you were going to use it for, and the non-accredited investor might ask for it back. You have to refuse. They might contact a lawyer. They might become disgruntled. So if you can raise money from just accredited investors, that's what we recommend. Now, using this exemption, you cannot advertise or conduct a general solicitation. So you can only contact people with whom the officers and directors have pre-existing substantive relationships. No friends of friends, no referrals, no putting it on your website, none of it. So it is limited in that respect. Benefit of this offering is the investors need to only check a box representing that they are accredited. They don't need to prove how they are accredited or that what they are saying is true. Another big benefit in this offering is that it's approved in all 50 states and with the federal government. So for your filings to perfect this exemption, you only need to make a notice filing with the SEC in the state of residence of the investor 15 days after the date of the sale in that state. And there's no review process, there's no comment process, it's just a notice filing. Now, the last private offering I want to talk about is Rule 506C. This was enacted in 2013 pursuant to the Jobs Act to help small companies raise money by allowing them to advertise and solicit. Interestingly, this was one of the rare times in the United States when every politician we have actually agreed on something. The Jobs Act was passed unanimously by members of both parties. So that's just a fun fact. Now, under Rule 506C, you can raise an unlimited amount of money from an unlimited number of accredited investors. No non-accredited investors are allowed. Disclosure document is required and usually takes the form of a PPM. But the big benefit is that unlimited advertising and general solicitation are allowed, meaning you can put your offering document on your website. You can talk about your offering on social media. You can give presentations. You can host dinners. You can get referred to investors from your lawyers or your friends or other investors. The advertising and general solicitation is unlimited. There's a catch. For all of these benefits, the investors not only need to check the box that they are accredited, they need to prove how they are accredited. They need to verify that what they're saying is true. So they need to provide an additional document to prove that they have the $1 million net worth or the annual income. That document can be anything. It can be a tax return, a financial statement, a bank statement, a brokerage account statement. We also include in our offering documentation package a certification form where a licensed professional, such as a tax preparer, a CPA, a lawyer, a broker, can sign to certify that what the investor is saying is true. That comes in handy if the investor doesn't want to give out personal financial information. The tax preparer just states and checks the box, yes, Lynn has this income. I've been doing her taxes for the last 3 years. So it's an easier way to verify it. And last, with this exemption, no filings are required, no looking things up to see if there's exemptions. You make the same notice filing with the SEC and the state of residence of each investor 15 days after you get the investment. So you are allowed to solicit in all 50 states. Now, moving away from the private offerings, which aren't really subject to review, comment, registration with the SEC, onto public offerings, which is typically the next stage in a company's growth if they're going to become a public company. We have regulation crowdfunding, which also came about as part of the Jobs Act, sometimes known as Reg CF. This public offering allows a company to raise up to $5 million every year from an unlimited number of accredited and non-accredited investors. This offering is not very popular. It can come in handy if you need to obtain a lot of shareholders. For example, if you're thinking about listing on a stock exchange and they require 300 shareholders, you can get a lot of shareholders through this offering. However, you can see my slide is very busy. There are a lot of requirements to this offering. For example, you need to prepare and file a disclosure document with the Securities and Exchange Commission. There isn't any review process, but you do need to have financial statements. Some of those financial statements need to be reviewed or audited depending upon how much money you are raising. And after you conduct this offering, the company is required to file an annual report with the SEC every year and provide it to investors. Tombstone advertising is allowed, meaning a tombstone is generally just one sheet of paper or one screen that has the name of the company, their address, what they do, and the amount of money they're raising. It's not very long. The advertising is not unlimited like in the private offerings we talked about. But blue sky filings, meaning the state filings, are not required. So you can't raise a lot of money from this offering, and you've got to jump through a lot of hoops. But if you need to get a lot of shareholders, it comes in handy. Now, a new public offering that came about from the Jobs Act is called Reg A Plus. This offering is very popular. In this offering, you can raise up to $75 million from an unlimited number of accredited and non-accredited investors. You have to prepare and file a disclosure document with the SEC. And this document goes through a review and comment process by the SEC. So they'll review it, the staff at the SEC will review it and perhaps give you some comments, change this, add a risk factor, and then you file an amendment and you go through this process back and forth until they're satisfied. Now, the Jobs Act promised that this would be a faster and easier offering to do as opposed to a regular public offering. And we sort of didn't believe that because we never believed the regulators, what they say, but it's actually been true. We have gotten Reg A plus offerings completed from about 30 to 60 days after filing with the SEC. So it has been a very quick process, surprisingly so. Benefit to this offering, unlimited advertising and general solicitation. So not just that tombstone. You can advertise however you want, wherever you want. Blue sky filings, meaning the state filings, are generally not required. You do need to have some financial statements, and they need to be audited, but not by a PCAOB registered audit firm. Biggest benefit to a Reg A Plus offering is liquidity. After this offering, the company stock can trade on the over-the-counter market. It's not a stock exchange such as the NASDAQ or the New York Stock Exchange, but it is a trading system, and your company can start trading there, and you can do what's called an uplist to a stock exchange later. But it does give the investors some liquidity, and the company is now a publicly traded company. The most common public offerings that people know about are what's called the regular way public offering. This is a traditional IPO. It involves preparing and filing a registration statement on Form S-1, which goes through with the SEC review and comment process. There's almost always an underwriter that's going to raise the money for the company. You can raise an unlimited amount of money from unlimited accredited and non-accredited investors. It can be a lengthy and expensive process. This is, a big deal IPO. You do need audited financial statements. And after this offering, you become a reporting company, meaning you have to file reports with the SEC and provide them to your investors. Biggest benefit, other than just raising money, of doing an IPO is your stock will then trade on a stock exchange if you meet the listing requirements. And generally in the US, it's NASDAQ or the New York Stock Exchange. Something that people don't really know about is what's a direct listing. And a direct listing is the same process as I just described for a regular IPO, but it doesn't have an underwriter. A company can, if they can raise enough money and manage the process, go public without an underwriter. It's called a direct listing. The company raises the money for itself, they go through the process, they file the listing application and get listed on the stock exchange. That's called a direct listing. And the last public offering I wanted to mention is a SPAC, Special Purpose Acquisition Company. This is the same as an IPO, but it's a shell company formed for the sole purpose of raising money and then used to acquire those funds to acquire operating businesses. So the company's document will have the types of businesses they're going to acquire with the money they raise. They raise the money, and then they have a certain amount of time in order to acquire those businesses. That's called de-SPAC. And with that, I'll leave you with a fun fact. The first IPO was in the Netherlands. The first Ponzi scheme was also in the Netherlands, and it involved tulip bulbs. Thanks for listening.
All right. Thank you, Lynn.